Hi everyone. In this lecture we are going to cover equities, futures and options, and I will try to keep it simple and not go into very much technical details. So what are equities? So equities are basically shares of companies which are listed on an exchange. So let's say there is a company name is ABC, and ABC company thinks that the fair value of the company is $100,000. So what does fair value mean? Fair value means the total value of the company. So if today ABC wants to sell its company and thinks that they are going to get 100k dollars in the market, and that is what the fair value of the company is. So for 100,000 USD, it will go to exchange such as NYSE or Nasdaq, and then let's say it says that it wants to list its share of 100 USD per share. That means it would have to sell 100 into 1000 shares in order to make 100k shares in the market. So what will happen to the company once the shares are listed? So basically once the shares are listed on the exchange, company will get $100,000, and this amount will be recorded as capital, as paid up capital in the balance sheet of the company. So for now, just understand that capital is something that is recorded in the balance sheet. And what is the so also there is one more thing that the company will record in its books or in the accounting process, is that the value of every share that they have sold is 100 USD, and that is called the book value of share price or book value per share. So when the equity is first listed, it is called the primary market, and once it starts trading in the market, it is called the secondary market. So in the secondary market, investors or traders buy or sell the same security once it is listed. So what kind of benefit does the company get once it is listed? So company does not get any kind of money once it is listed. So company will only be able to see what is the total value of the company in the market. So if people feel that the company is higher value than just 100 USD, or let's say from 100 USD it goes to 500 USD in the secondary market once people start to buy and sell the security. So if they feel that the price that they are paying currently, the company is undervalued, that the company has higher value in the real market, then they will continue to trade the share and the prices will go up. So company will benefit from the higher pricing in the market, and they will say that they have very good reputation in the market and they're getting higher value than what they initially listed. That means that the company is actually growing, and investors will feel confidence in investing in the company. Company will easily get loans or any other benefit that they are seeking in the other markets in the real case scenario. So that is the benefit that the company gets. And in case the company is not doing good and people feel that the company is not worth 100 USD, then the price of the share will continue to go down, and in that case the prices will go down, and the company would have to face problems or challenges in terms of financing, in terms of getting loans or any other activity or operations that they might be doing. So let's try to understand what will happen in case you purchase an equity. Let's say you purchase for 100 USD. So in this case, this is the payoff graph. That means how much amount of profit or loss that you are going to get. So let me mark this as profit loss. So if the price of the security goes up, your profit will go up. For every 10 USD, your profit will go by 10 USD. So for 110 USD, your profit will be 10 USD, and so on. And it will continue to go. And if the prices go down, then your losses would increase, and so on. Next, let's try to understand what are futures. So futures are something that are based on equities. So this is based on stock price. Stock price is also called as spot price. So depending on whether market is going up or going down, the price of the futures may change. How will they change? So basically futures has three components. One is the buying price of the future, second one is the strike price, and third one is the expiry. So buying price is the price at which I can buy the future. Strike price is basically the expected, or I would say expected or future spot price. For example, today the spot price is just 100 USD, but in future I feel that there are many possibilities, and possibly the stock can go to, let's say, 80 USD, or it can go to 120 USD, and so on. So depending on whatever I feel is the expected price, I will keep the strike price. So 80 can be the strike price, 90 can be strike price, 100 can be strike price. So depending on whoever is trying to create that future will create a strike price, and based on the strike price the person will keep the buying price of that future. And the price of the future can change depending on what the person feel. If the market is going up, then the prices of higher strike futures, that is the futures which have higher price than the current spot price or the stock price, will continue to go up. Whereas in case the market is falling, then they feel that the possibly the stock is going to go down, then the price in the lower direction, then the price of the higher strike futures would increase, or the price of the lower strike futures may increase, depending on how the market is playing. Expiry is the date on which that particular future will stop trading. So let's say by the end of this month the futures will stop trading, or that is the expiry date of that future. So let's try to understand call and put option in simple way. So whatever is the buying price of a call or put option, that is called the premium of that option. So whenever you are buying a call or put option, you have to pay the premium to buy it. Okay, so here we are going to talk about only option buying. So there are two types of things that you can do in the market. One is option buying, another one is option selling. If you are buying first, then you have to sell the option at a later stage. If you are selling first, then you have to buy the option at a later stage. So we are going to talk only about option buying in order not to confuse people who don't know much about the market. So in case of buying a call or a put, if you buy call or a put, then in that case the maximum loss is limited to the premium. So maximum loss is premium loss, whatever you have paid. For example, if you have paid 10 USD for buying that option, then the maximum loss that you can incur on your account is only 10 USD, whereas theoretically the maximum profit in the market is unlimited in call and put both. Now options also have a thing called decay, or it is also called as theta decay or time decay of that option. So what does it mean? So it means that if the market stays in the same condition over a period of time, then because of time decay or theta decay, the value of that option would continue to go down. Value means the price or the premium of that option over time would continue to decrease. So let's say at time t the market was at the same place, the market moved up, moved down, or did anything in between, and then stayed at the same position after t plus 1 hour. At t the price was, let's say, 10 USD, and because of theta decay there was a loss of 2 USD, then the current premium would be only 8 USD. So you have to pay 10 USD at the beginning of the market, but after 1 hour you just have to pay 8 USD to buy the same option. So this is called the theta decay. Now let's try to understand how call and put option work, or when they are going to give profit or when they are going to give loss to the option buyer. So basically, whenever the market is going up, then in that case the call option will give you profit. As the market goes up, call option would also go up. Whereas in case of put, if the market goes down, then the put option value of the put option would increase, and when the market goes down, then the put will also increase. So in that case, if the market is going up, call will be profitable, and if the market is going down, then the put will be profitable. And opposite scenario will be there. In case the market goes down, then there will be a loss in the value of the call option, and if the market is going up, then there will be a loss in the value of the put option. So these are the conditions under which call and put option would give profit or loss. Let me know if you want to know the technical details behind call and put options in the comment. Thank you so much.